We are live. So it is Tuesday. It's 6 p.m., which means it's time for the weekly Q&A office hours. I'm Neil, your host. We got Serena on the line here. She's the magic person that does all the stuff. It is Tuesday. We do these every week. We have office hours. People writing questions. They write in on email or they come up on calls that we have with clients, or they post them to our navigators or our explorers group. All kinds of ways we get questions, and people always have questions. So we want to take this time to make these accessible to everybody, because somebody else is going to have a question. It might apply to your situation, and maybe you can get something out of it. And just generally understanding more about everything that's going on. So like I said, I'm Neil. I am the founder, chief tax strategist here at Tax Sherpa. I'll give you the quick. So back in 2000, 24 years ago, 24 and a half years ago at this point, I was working in corporate engineering as a college intern. And I realized this whole thing is not for me. So I was a little late at that point, realizing that we do what we can with what we got. So I went up on my own entrepreneurial journey. And over the next several years, I had some successes, had some failures. And then in 2007, I started getting letters from the IRS saying I owed them $1.3 million. So like most people, when I get a scary letter from the IRS, I stuck my head in the sand and I ignored it. So for the next couple of years, I kept getting letters. I got certified mail letters. Then I got phone calls. And then 2 years into this process, they started garnishing. And I was like, yeah, I got to fix my problem. So I ended up, in searching for someone to help me fix my own problem, I ended up hooking up with my mentor, who was a former Wall Street tax attorney. And he showed me the ropes, and he helped me fix my problems, which took about a year, honestly. And then in doing so, his business was starting to grow. He needed help. So I came in to help him on the business operations side. And we tripled his business over the next couple of years. And he showed me this whole world of Wall Street style tax planning that I never knew existed. And since that time, over the last 15 years, I've worked on over 50,000 tax returns, on billions of dollars with client earnings, and saving people like over that time, like hundreds of millions of dollars, which has been great, because my personal mission is to help small business people like me not pay the government. So I want to defund the government. And Serena and I, we have our company Slack that we're communicating on all the time. And a week or so ago, I was sharing statistics that the IRS collects on tax returns and things like that. If you looked at my computer, you'd see 18 open spreadsheets of all different statistics, publications that the IRS makes. And they break it down by filing type and business category and all this kind of stuff. Fascinating stuff. At some point, we'll get together and create special reports of, as far as like, would you like to know what's the most profitable businesses in America? The IRS knows, and they'll tell you, but you got to be able to read the data. And how many people are filing things in what I consider to be the wrong way? Well, it's 29 million, which is insanity, is what it is. So we're doing our part here to reach those 29 million people and help them save tons of money on their taxes. That's what we do. I like questions. Quality of our questions determines the quality of our life, which is a Tony Robbins quote. And I think it's a great quote because I think it's really true. If you ask the wrong questions, you get the wrong answers, you do the wrong things. If you ask the right questions and you get the right answers, then you do the right things. And right is obviously subjective, right? That it means I'm a big fan of the Stephen Covey approach, the urgency versus importance. An important thing is something that moves you closer towards your goal. And what is your goal for the small business crowd, for the solopreneurs, for the independent contractors out there? The goal is 1, financial security, 2 is financial freedom, and 3 is time freedom. And in that order, how many of the small business people that we work with are just killing themselves at work? And I'm just as guilty as everybody else, to be honest. But there is a fix for that. And this goes into the root problem with overpaying on taxes. Because if you go to work and then you do whatever it is you do, you come home and you take the money you earned that day and you hand it over to the government, what did you actually do that day? I mean, you did stuff, but it wasn't for your benefit. It wasn't for your business. It wasn't for your family. It wasn't for your community. It was for giving to the government. And just today, I read a publication that there was a report out for FEMA, just the Federal Emergency Management Authority, that's what it stands for. If there's a flood or an earthquake or a hurricane or something, they come in and they distribute food and whatever. $8.3 billion is sitting unknown since 2012 that they haven't spent, that they were supposed to spend for relief aid. And it just went into an account. Nobody knows where it went. just lost. They lost $8.3 billion. And this is over 12 years ago. So this is definitely lost at this point. And this is the kind of things, this is why nobody should pay taxes, to be honest, because that's what they do with your money. They lose it, or they waste it, or they spend it on stuff that you don't like. And a very small sliver, they spend on stuff that you would agree with. But the vast majority is waste or actual bad things. So the root problem is that you're wasting 20% of your life. That's 74 days every year. So those days that, when a new client comes to us and we lay out their tax situation, and we've got a 4-step process, there's a survey where we figure out where you are, what's going on in your tax life. The route is stage 2 is that, okay, from where you are, where can we go? We map out the route. And then step 3 is the track. Let's say, okay, now we got to do the work. We got to put in place whatever strategies we need. We need to do entity restructuring, whatever the case is for that particular situation. And then once we're on the track and we're going along, we got to do compass checks along the way. That's step 4, where we review and modify. Because sometimes, I thought I was going to make this much this year. It's actually way more, or it's way less, or whatever. Or I got divorced, or I got married. We had one client who got divorced and then remarried within, 3 months? Something.
Yes, that's true.
So we had to adjust the plans from the divorce. And it was like, okay, we're going to do X, Y, Z. And then his mother emailed us and said, oh yeah, he got married. So now we're scrambling and now we got to do not just XYZ, but we've got to do ABC to figure out the rest. So, along the way, things change, life changes. That's the only constant. So we have to check up along the way. So that's the problem, is you're wasting 74 days a year, every year. And if you can get those back for yourself, then for most of our clients, that's going to mean I can reinvest that much more time, energy, and money into my own business. But you could also take that money and go to Vegas, or to go on a vacation with your family, or any other thing that you choose to do with that time. I want everybody to have that freedom added to their lives. It's what we do. So everybody has questions, and they have all different kinds of questions, but I know the answers to every single question when it comes to the tax world, at least. And the answer is, it depends.
It depends.
So it depends, because everybody's situation is different, and facts and circumstances dictate so much in the tax world. I have all kinds of examples of this, but I'm going to go with the cosmetic surgery again. So you get a nose job. Is that a medical expense? Is that tax deductible? Maybe. Depends. And it depends on whether it's elective. It depends on whether you have a medical reimbursement plan in place. It depends on if it's a reconstruction or a fix of, if you get into a car accident, face gets smashed. That is a medical medical expense that's deductible, versus I just don't like my nose and I got a nose job. That's not a medical expense, because it's a limb. It's just your choice. It depends. It depends on all kinds of stuff that goes into the facts and circumstances of the case. And I could just talk for the next hour about all the different times where facts and circumstances has made the difference from situation A to situation. That is, before we get into the Q&As, I wanted to go over 2 stories that are new this week in the tax world. And I read IRS publications, so you don't have to. But story number 1 is a crazy story. On September 6th, that was last Friday, the IRS put out a publication or a press release saying that they've sentenced these guys in Round Rock, Texas, with a tax fraud scheme. There's all kinds of tax fraud schemes. This one was particularly aggressive and somewhat ingenious, in that there were these 7 guys, and they first started off by stealing the identities of accountants. So people like me and Serena. And what they did was they took those identity information pieces and then stole the identities of other taxpayers. And then they contacted the IRS and changed all of their contact information for those taxpayers to new addresses that they control. And so they did all that, because that's just a form you file with the IRS. It's an 8822 change of address form. And then they got transcripts of these taxpayers mailed to them. And based on the transcripts, they were able to file amended tax returns. So in an amended tax return, what happens is that first you file what is already on file with the IRS. So you have to match that. And then you have to file whatever has changed. That's what you're amending your tax return to reflect new information. And then you attach an explanation and you send it to the IRS. And if an amount is owed, you send them to payment. If an amount is due for a refund, they'll send you a refund. So they did this. And before they got caught, they managed to get $30 million of refunds, which is a crazy amount. And then they got them sent as prepaid debit cards, which is like the number one fraud vehicle for tax refunds. And then they took those debit cards because that's anonymous spending, and they used that to buy money orders, which is double anonymous. And eventually they did get caught though, and they were put on trial, convicted, and sentenced last Friday. So the crazy thing about this is that by impersonating the people who were already registered with the IRS as tax preparers in good standing, they were able to get around the IRS's attempts to verify identity. Because when the IRS, when they receive information like a tax return or anything like that, sometimes what they'll do, and they're doing this more and more, is they'll send out a letter, an identity verification letter, where they'll ask about 8 or 9 questions, and you have to match up things that are on the tax return. But because they had already changed the addresses of all these people to addresses they now controlled, those identity verification requests went to them. And so they said, yeah, it's XYZ. And I sent it back, and I said, okay, great. Identity verification has been verified, and we'll process the refund. And here you go. Just wild stuff. That's probably the most sophisticated identity theft ring I've seen or I've heard of like that. There have been all kinds of identity theft issues, but that is definitely the most sophisticated. It's worth noting that pretty much everybody in America has had their social security number hacked. There was a report out about a month ago where one of these big data broker organizations, they had gotten hacked 2 years ago, and the packages of data were for sale on the dark web. And that was one level of problem. And then back in March, somebody posted the package of data online for free. So they weren't selling it anymore. So it's just, here's everybody's information. And there have been some security, if you can hear that, there have been some security firms who have parsed through the data, and you can actually go in and look online to see if your data's hacked. So I looked up myself, and sure enough, my name and my social security number were there, and they had the address, and they actually had my parents' address, which I haven't lived at since 1997. Not quite sure where the data sources are that old, but they still had name and social security number. So my number's out there, and your number is probably out there too. So when social security was invented, it was specifically said, this is not to be used as a national identification number, but that's what it's turned into because it's so easy for all organizations to use to identify a unique human being in America. So it's not a secure system. You get issued a piece of paper on when you're born. Right? So this is just up to date with any kind of modern technology. And these are parts of the prices that we have to pay for that. Be mindful of your identity information, monitor your credit bureaus, do all that. In fact, I got a buddy of mine who has yeah, Charlie, I'll get you that link. It's in one of my old emails. I'll try to find that before the end of the show. My buddy Makani, he has I Hate Passwords Academy, ihpacademy.com. And he teaches people how to be safe online, essentially, which is a great service that is vastly needed. Okay, tell you what, Serena, we'll get to the next story in after I look up that link. But what is our first question?
So we have someone that's trying to relocate to another state, and they're trying to go from Colorado to California, and they want to know what's their tax implication just from that move, and are the state taxes going to be pretty high going into California?
Yes.
I'm laughing at that one because it is.
Yes. They are going to be high. Oh, and here's the link. It's pentester.com. Let's just put a button on that. So .com, put in your name, you put in your state of birth, I think it is, and then your birth year, and it'll tell you stuff. It is a scary tool, but put that in the chat here. That guy right there. Yeah. So going from Colorado to California, Colorado's already pretty high. It's not super high, but it's higher than a lot. But yeah, going to California is going to be more painful. So California actually just raised their top rates up to 13%. I think it was. Maybe it was 13 to 15 or 11 to 13. I can't remember off the top of my head, but they just raised their top rates for the high earners. And obviously that doesn't affect most people, but it's certainly a trend, right? It is a very high tax state. There are, in fact, we had a client that we were talking to this past week, and she's going into partnership. She's not in California, but the partner is in California, and their home base of their partnership is going to be outside California. and they're mostly doing remote work. The location is going to be wherever they're physically located. So I was explaining to her that, okay, for you, for your work, where you're sitting in not California, you're not going to have to pay California taxes. For him, he is going to have to pay California taxes because the way pretty much every state works, especially with flow throughs, is that the whatever income is made has a source, and you're going to pay tax in that source state. Sometimes city as well if there's city taxes, but for most states it's just state tax. And that income is going to come home to you, and you're going to pay your state income tax on wherever you live, wherever your tax residence is. So that's all fine. And like I'm in Georgia. So Georgia tax rate is about 5%. So if I make money in Tennessee, let's say, so Tennessee doesn't have a personal income tax. So that has not been taxed by a state yet. It comes home to me in Georgia. I'm going to pick up the 5% on that income. So that is the process that it works by. Problem with California is like California's higher than everybody else, except for maybe Hawaii. Whatever you're doing, if you're a California resident, that income is going to come home to you in California, and you're going to have to pay California rates on that income. That is what happens. So whatever you're making, you're going to be paying higher taxes in California than you are in Colorado. Now, the one silver lining ish to doing that is that California does allow 2106 expenses. So one of the changes from the Tax Cut and Jobs Act, which was Trump's tax reform, was that they got rid of a lot of stuff at the personal level. One of the things they got rid of was on your itemized deductions. If you have expenses related to your day job that for a business you do not own, then you were able to deduct those on your tax return. Certain limits apply. And they got rid of that in 2017. So California, though, kept it. So if you have, let's say you have a day job, you work for somebody else, but you have a home office. Federally, home office doesn't count for anything because it's not your business home office. It's a day job home office. And so even though it's an unreimbursed business expense, the maintenance associated with that home office area, it doesn't factor into your income federally, but it does in California because they kept the unreimbursed business expense deduction. Small, tiny, the smallest of silver linings there, but it is one deduction that they have that the feds got rid of. So there's that. California does allow for deduction of moving expenses. Generally, when you move across states, this was another thing that was gotten rid of at the federal level, but a lot of states kept that one where, okay, it's going to cost you $5,000 to move from Colorado to California. Generally, you'll apportion half of that expense to Colorado and half that expense to California, as long as the move was for work purposes. If it was just because I like the scenery better, then technically it does. But as long as it's for work and it's more than 50 miles, then usually that is a state level deduction. Yeah. Other things about the move, you got to be careful with your dates. Make sure that you actually report when you do that. If you travel beforehand, this is something people overlook a lot. If you traveled before the move, so like you flew out and you checked out places and looking for a house or an apartment or something, then that will factor into those moving expenses that you can deduct at the state level. But yeah, overall, you could pay more in California. That's just the short version. I wish it were otherwise. The California is super aggressive. They, so here's another thing that's bad about California is that there's no statute of limitation. So federally, there's a 10-year statute of limitations. So if you get a letter from the IRS, so right now we're sitting here in 2024 and the current tax filing year is 2023 because we're a year behind. So if you got a tax letter saying, hey, in 2009, you didn't file this thing, you just write back statute of limitations, go pound sand. And most of the time that will take care of it. Certain exceptions apply, and as always. But California has no statute of limitations. I had one client, this was back in 2015, 2016, something like that, older woman. And she brings in a letter to my office. This is back when we had offices that were in person, pre-2020. And she brought me this letter and she says, I got this letter. I don't know what it means here. So it was from the Franchise Tax Board of California, which is their state level tax agency. And they sent this letter, said, you owe us unpaid tax from 1978 and including penalties and interest is $1,000. And that's all it says. It says you owe us money, basically. And because California has no statute of limitations, they are technically within the law to request for this payment. So we ended up just writing a letter back saying, for what? there's no explanation of the letter. So what are you claiming that we owe this tax? And they just dropped it because they never responded. But yeah, California is super aggressive. They have no statute of limitations when it comes to tax. So those are things to be aware of if you're moving into California. I understand that the weather's nice, but I can't imagine that anything being worse dealing with California. That may be a personal bias. I don't know.
Right. Is the weather worth it?
Is the weather worth it? Yeah. The Southeast is way more humid. Yes. Then you don't get that dry heat. It's like wet heat. Looks pretty good here. So take that for what it's worth. Yeah. So story number 2. This is a fun one because this is somebody suing the IRS. There is a law called the Johnson Amendment. It's actually from Lyndon Johnson, who later became president. But back when he was in the Senate, he got an amendment attached to a law where nonprofits are like 501c3 organizations are not allowed to campaign politically, or they're not allowed to get involved. And this is true. This is the law. So, you know, the IRS has the job of enforcing nonprofits to be nonprofits and that they follow all these rules. And if you lose your nonprofit status, obviously that's not great because then you got to pay tax on all this stuff. This organization, the National Religious Broadcasters, Sand Springs Church, First Baptist Church, Wascom, and Intercessors for America, they are suing the IRS. And this came out, it was filed back on August 28th, but the story came out, it was either yesterday or today. And basically what they're saying is that, hey, you IRS are in violation of equal protection under the law because you're only targeting this campaign political action, enforcement action against conservative leaning institutions and not liberal leaning institutions. And it's an interesting argument. And I don't know the numbers on how true that claim is, but I do know that I have seen many politicians give political speeches at many churches. And at least where I am, they're mostly Democrat. I don't know if that trend holds true nationally. I don't know if in more rural areas they trend more Republican, but it is a definite action that I have seen. So I went to the IRS and I said, what are the rules about this? Because how much is political speech and how much is just private actor kind of stuff? And there's actually a revenue ruling from 2007 that spells out 21 different cases of what is and what isn't acceptable in these cases. So the big one is candidate appearances. That's the one I see the most personally. And depending on the fact and the circumstances, so even the IRS is saying it depends. An organization may invite political candidates to speak at its events without jeopardizing its tax exempt status. Political candidates may be invited in their capacity as candidates or in their individual capacity, not as candidates. Candidates may also appear without an invitation at organization events that are open to the public. When a candidate is invited to speak at an organization event in his or her capacity as political candidate, factors in determining whether the organization participated or intervened in a political campaign include the following: whether the organization provides an equal opportunity to participate to political candidates seeking the same office. Is it open to everybody, or did you just invite one candidate? Whether the organization indicates any support or opposition to the candidate. If somebody's coming and speaking, that's one thing. If somebody's coming and speaking and says, yes, we like this guy, that's another thing. And whether any political fundraising occurs. I've definitely seen places violate these rules. But the interesting thing about this claim, though, is that, or the complaint that's being filed against the IRS here, is that they're not saying that you should crack down on the lefty versions of what we do. What they're claiming is that all 501c3s should be able to engage in political speech. So they're trying to upend the whole thing. And it's an interesting argument because there's another law that was passed in the 80s that says that the government cannot interfere with people's religious freedoms, essentially. And they're making the argument that is what is covered here. So if let's say I owned a church and we skew Republican, if I'm saying the Bible says we should vote for this guy, then that should be religious protected speech, because that's the argument that they're making. It'll be interesting to see where this goes, if anywhere. A lot of court cases don't go anywhere, but I always like cases where the IRS is getting sued proactively. So I thought I'd bring that to everyone's attention, because let's sue them into oblivion. Just as an aside, fun fact, the Church of Scientology, that's how they got their tax exempt status confirmed. So the IRS was saying that we're not really sure you're a church because you own all this real estate and you do all this business type operations. And so they just started filing lawsuits against the IRS and against IRS agents individually. And they just buried them in legal work, and the IRS just backed off. It's a proven strategy that works. Anywho, so that was the second story that I wanted to share with everybody tonight. IRS is saying it depends. And these people who are suing the IRS are saying it doesn't depend. Everybody should be free to say whatever they want when it comes to
Right.
political speech, even if we're nonprofit tax exempt thing. All right. So what do we have next, Rita? What other questions do we have?
So I have a question from a client about hiring her kids. So she wants to know what's the process to do that.
Hiring your kids. Yes.
What's the correct process?
The correct process. Yes. There are many ways to do it. There's one way to do it correctly as far as I'm concerned. The correct way to do it is you have an LLC partnership where the partners are the parents of the child, and the child has to be between the ages of 8 and 17, and you got to pay them on an actual payroll system, and there has to be an actual job, and you have to keep actual hours and all those things. The thing about it is that when you have a partnership and the partners are the parents of the child that is employed, then what happens is that those wages are exempt from Social Security tax, they're exempt from Medicare tax, they're exempt from unemployment tax, basically tax-free. And if you pay them less than the standard deduction for the year, then it's income tax-free as well. So just totally tax-free if you set it up right. It can also be done under a sole proprietorship, Schedule C. But for other reasons, we don't like Schedule Cs because they just increase your audit risk unnecessarily. And I've got a whole presentation on that they're probably not going to have time to go into. But yeah, so, and the reason for these exemptions being under this particular structure is because the parent is going to pick up the self-employment tax from any profits generated by those entities. So even though the kid's not paying them, the parent is potentially. And that's why those restrictions work. We had one client this year who was a new client, and she had set up a payroll for her kids, but she did it under an S corporation. And it's like, yeah, you did it wrong because the S corporation does not enjoy those exemptions. So you might be exempt from the income tax if you just structure the amount of payment under the standard deduction, but you are not exempt from the Social Security and the Medicare and the unemployment, which is 15.5% when you combine all that together. It still worked, but it was not as efficient as it could have been if that client had done it correctly and talked to us before. That's the way to do it. And there's more that goes into it. Like I said, you got to keep timesheets. You got to have a reasonable wage based on the job that they do. In fact, Serena, I haven't even told you this yet, but last week, the IRS announced that they're holding a comment period because in 2027, there is a new tax credit that's coming into play. And that is for low income earners who contribute to retirement savings. They're changing the retirement credit. So currently, the retirement credit exists. And if you're low income and you contribute to a retirement plan, an IRA or 401k or something, then they give you a tax credit on your tax return. However, that tax credit is non-refundable, meaning that if you don't owe any tax, it doesn't help it. So what they're doing is they're changing the credit, and this is from the Secure 2.0 Act. They're changing the credit, and it's going to, one, it's going to be refundable up to $1,000. And two, it's going to be not sent to the taxpayer directly. It's going to be sent to their retirement account. And the IRS is holding comments for industry related people. So they're saying, how should we make this thing work? Because we have a couple of years to get this enacted, and it's going to go into effect in 2027. So I was doing the math, and if you had a kid and you put them on our Climber plan, which is the supercharged version of putting your kids on payroll because it gets them involved in contributing to retirement accounts, and you claim this $1,000 tax credit from 2027 onward, by the time that kid retires at age 65, they end up with an extra $600,000 in their retirement accounts. So effectively, assuming that future financial projections, blah, 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 then the IRS is giving your kids up to $600,000 tax free if you set this up right. So that's going to be definitely an area of focus that we have going forward. And I'm building out the tools as far as building those projection worksheets. And that just shouldn't be. So this is a worksheet that I've been working on, where basically, if you start at age 8 and you go to age 17 and you contribute $7,000 a year to an IRA, which is the current maximum contribution, and we assume an 8% investment return, which is in line with long-term averages, you end up with $4 million at age 65. So you could be putting money from 8 to 17 and you never put in another dollar and you just let it grow and you leave it alone. You end up with $4 million at age 65 using the 8% investment return, which is pretty standard in the financial modeling kind of world. So question becomes, what happens if we add an extra 1,000 on top of that? We go from 7,000 to 8,000 a year and we go up to 4.6 million. So that's the extra 600,000 that comes in. This is going to be a super powerful long-term wealth building strategy for your kids that also gives you a tax break at the same time. Part of the tooling is to model out how much tax break do you get? And does that pay for the amount that is actually going into the IRA? And in a lot of cases, it's real close. So you might be out of pocket a little bit, but overall, pretty much free to make your kids into millionaires, assuming they can leave their accounts alone. And that's the key
Wow.
thing when it comes to retirement plans. Super powerful strategy and will be more and more powerful as this tax credit comes into effect in 2027. So speaking of tools, Serena wanted me to show you guys this other thing. So I do a lot with AI. I do a lot with building the tools to do stuff because fundamentally, all the information that I have in my head, I'm happy to share. I do these live streams. We're not holding anything back. This is just the real facts of how things lay out in the tax world. And I'm happy to share because fundamentally, even if I told you everything, you don't want to become a tax professional, right? So you're still going to come and ask us to do the dirty work for you because we all need to specialize, right? So we specialize on the tax stuff. You specialize in whatever it is you do. I hire all kinds of people for all kinds of things. But what I really want is I want people in our tribe to be able to understand what is going on and the strategies that are available to them. So I want them to be able to see how the numbers shift and how, if we put this into place, I'm able to save $10,000 this year. And then I could use that $10,000 to go do whatever it is I want. And I really want people to be able to use that information. I built, among other things that are in process, I built this AI system where it's talking about business loans. So a lot of people get really confused about debt in businesses because what the key factor is when it comes to selling a business and when it comes to taking losses in the current year is your basis. So the basis is a measure of how much net investment you have in the business. So if I put in $100,000, a new business, let's say, and in the first year I generate a $70,000 loss, my basis is now reduced by $70,000 and my remaining basis is 30 grand. So if the next year I lost $50,000, I can only get 30 because my basis is 30. So the extra 20 rolls forward and it's not currently deducted. So these kind of issues surprise people a lot of times when they're dealing with debt, because if you take on debt, that gives you leverage to spend more and that might create more tax losses, but those may not be actually useful to you as the owner because it depends on basis. So I built this chatbot that was trained by me that goes through the different scenarios, all the it depends stuff of what kind of entity structure it is, what kind of tax elections you have, whether the debt is personally guaranteed or company guaranteed, and all those kinds of things. And it allows you to work through, okay, I'm looking at this particular scenario. So like for me personally, I'm looking at buying a firm that's here locally and they're asking $200,000. So I could just pay $200,000, but I'd rather use debt. And given my structuring of tax SureQuote, how does that affect my ability to take losses and all those kinds of things? And the AI chatbot will go through those different scenarios based on what it is that you're looking at doing, and it will let how this affects your particular situation. So that's just one of many tools. I actually rolled out recently a penalty eraser, where if you get a late filing penalty, it'll create a letter for you to send back to the IRS to get rid of it, which is fantastic. Because the fundamental problem with the IRS, we have this, how do I say this? The IRS doesn't read their mail. So there are forms to be filed. The forms that we file all the time, right? There's Form 2553. That's an S corporation way. There's Form 8821. That's an authorization for us to look at tax return transcripts. There's Form 7004. Those are the extensions for businesses. We file these 3 forms all the time. And maybe 50% are actually processed correctly by the IRS. And it's a constant battle. And it generates issues later on when we try to file. Okay, we filed a 2553 last year, and now we're filing an S corporation return, which matches up 2553. And the IRS says, oh, it's the wrong kind of company, the wrong kind of return. We're like, but we sent you the thing. Don't have it. So we got to send it again. We've got one client that got a letter this past week or so with this particular issue. This guy, we have sent in 4 times this same form, and they just can't seem to get it through their processing to actually elect the correct status. And so we're going to send it in a 5th time, and maybe somebody with a brain will actually receive it and be able to process it. I don't know, but we'll keep trying. So there's a limit to what we can actually do once we send things over to the IRS, but we can do all the things that we're supposed to do, and we can just keep hammering away at the IRS until they follow their own guidelines. That's just a little side rant. What else do we have on the list? Oh, we got a question in the chat. As a taxpayer,
I was waiting for you to see that
tax
one.
pro, do you prefer Kamala's tax proposal over Trump's? I understand if you refuse to provide opinion. Yeah,
I want to hear this one, Neil.
so here's a controversial take. Business would be better for tax Sherpa if Kamala gets elected, because taxes will go up and people will need more help. However, my mission is to actually defund the government as much as possible. And so I would prefer Trump's tax policies of making the current Tax Cut and Jobs Act reforms permanent instead of ending in 2026. And also, he wants to lower the corporate rate from 21% to 15%, which we'll take that too. It's not a big mover, to be honest, but it is, every little bit helps. So yeah, personally, if I'm just looking for self-enrichment, Kamala's tax hikes, come to us. We'll save you from them. But realistically, yeah, Trump's is going to be better for the country, for everybody as a whole. So that's the answer. It depends. All right. What else have we got, Sri?
We have a client that lives in California and she
California.
has 3 businesses, and 2 is they're under the health wellness, and then the other one is warehouse. Her thing is she doesn't have any LLCs formed at all for any of the companies.
She owns
So
a
what
warehouse
should
and
she
she
do
doesn't have
to-
an LLC.
Yeah, she
Okay.
doesn't. Well, she rents a warehouse. She doesn't
Oh,
own
she-
it. She
I
rents
don't-
it. Yeah. So she's just trying to figure out what's the best foundation to get everything organized. Should she do an umbrella setup, or should she do 2 LLCs, an S corp? What should she do?
Yeah. So that's an interesting one. So typically, you could put it all into one if you really wanted to. So on a tax basis, it doesn't actually make a difference because everything's going to flow through into one and then come home to the owner without trying to step on the lawyer's toes, because we are not attorneys. Generally, the way to go would be to form an LLC for each business entity. In this case, it'd be 3 different entities, and then have an overarching umbrella S corp. That'd be the typical structure. And the reason to do that is a couple things. So one is that if you're ever looking to sell one business and not just the whole thing, it makes it a lot easier if each business files its own tax returns. Because when you go to sell, they're going to want your financials. They're going to want your tax return. Say, okay, here you go. And this is just this. And it's very simple, very easy to explain to a buyer. That is generally the best situation and creates the least amount of friction to a sale, because most businesses do not sell. And you can talk to business brokers about that fact and how people don't keep good records, which is a problem. They flim flam on their tax returns, which is another problem. And they don't have the proof that this is an actual business asset rather than just trying to sell a job. So that is a whole separate conversation. But if you have clean financials per entity and each one is separately structured legally, so each has its own LLC, and then they have the tax returns and creates the history, then that makes it as easy as possible for all of the later transactions. And then from a tax perspective, you apply whatever strategies you want to at that umbrella limit. And that way it doesn't affect the underlings, but it still mitigates your personal situation. So those are all the general approaches. Now, there may be other considerations depending on the particulars of that situation, but that's the basic starting point that we go with. And unless there was a reason to change it, that's what we recommend.
Awesome. That's okay. So we have another one about selling some stock. Client X, I'm thinking of selling some stock I've held for a while. How would
Yep.
that affect my taxes? And is there a good time to sell to reduce the taxes?
Depends on what happens in November, but
It depends.
it depends. So I'm going to assume that stock has been held for more than a year, which makes it long-term instead of short-term. It's just the same as any other kind of income for income tax purposes. They call it short-term capital gains rate, but it's the exact same as your ordinary rate. So it's a distinction without difference. Long-term capital gains Generally, it depends on how much income you have for the year, because long-term capital gains is either going to be 0% tax, 15%, or 20%. And also, depending on if you're over 250K or not, you might also pay an extra 3.8%. So it could be anywhere from 0% tax up to 23.8% tax. If you're in the 0% bracket, then go nuts. Sell the stuff. Assuming you want to sell for whatever reasons, right? If you are in the 15 or 20 or 23.8% brackets, then you want to apply a little bit more care to it. So there is a strategy called tax loss harvesting. And this sounds complicated, but it's actually pretty straightforward. So you have your sale and you have whatever gain you have. Let's just say it's $20,000. So you have $20,000 of gains that you would pay 20% on. That's $6,000. So if that's all your gains and that's all your activity, then that's your capital gains tax. Now you could apply other strategies outside of the capital gains sphere in order to try to mitigate that. That's like an infinite number of things that you could do. Within the capital gains world, you could apply tax loss harvesting, where if you sell some winners, you try to sell a bunch of losers to offset the winners. So if I've got $20,000 of gains from this thing that I like, and I've got these losers sitting here that are, $15,000 worth of losses, I can sell those losses, capture that, and that's going to reduce my gain from 20 to 5. And now I'm looking at 20% on 5,000 instead of 20% on 20,000. So my tax goes from 6,000 to 1,000, basically. So that's the tried and true method. Couple things about selling losers. There is a rule called the wash sale. And what that says is that if you sell something for a loss, you cannot buy it back for at least 30 days. Because if you do, they will discount the loss. If you plan to sell the losers, but you think they're going to turn around and you want to buy them back, wait at least 31 days, 32 days to be safe, and wait for that in order to expire and then buy them back. Now, you might lose something in between. Things happen. That's part of the risk, but that's the wash sale. Second point, wash sale rules do not apply to cryptocurrency because of how the IRS treats cryptocurrency. They treat it as property, and effectively you have the same kind of capital gains and losses as you do with stock. So if you have losers in cryptocurrency, which a lot of people do, you can sell those and realize those losses against any potential gains that you have. And then you are not subject to the wash sale. So that's worth knowing. I have seen a couple of people use that to great effect over the years. But obviously you need to have that already in place in order for that to make sense. But a lot of people do. So it's definitely worth knowing. All right. One more, Sarita, and then I got to go because I actually have to run right after this to a business networking thing.
Okay. Alrighty. So another client asks, I've been considering converting my traditional IRA to Roth. What should I know about the tax implications before I make the switch?
Yeah. So the first thing to know is the difference between the two. So traditional is where you put money in and you got a tax deduction on when you put the money in. And then the deal with that is that when you take the money out in retirement, you have to pay taxes then. So that is the trade-off. So I get a tax break now, but I got a tax hit in retirement. Roth, on the other hand, I take the tax hit now. I don't get any deduction, but when I take the money out in retirement, it's tax-free. So that's the trade-off. Do I want the tax benefit now and tax problem later? Or do I want to have the tax problem now and have tax benefit later? So that's the trade-off. So there are ways to convert, right? So if you have a balance in a traditional IRA or traditional 401k and you want to roll it over to a Roth, then you can do that. You can elect to do that basically whenever you choose, because rollovers from one retirement account to another are unlimited as long as you do it direct. The only issue is that rollover is taxed. If I have $50,000 in an IRA and I want to roll that over to a Roth, I'm going to have a $50,000 positive on my tax return in the year that I do that. And so the question becomes, does that work? Am I willing to pay that tax? And really the answer comes down to what your expectation of the future is. Because if you leave it in the IRA and you take money out in the future, 20 years, 30 years, 40 years down the line, then you're going to be paying tax at an unknown rate on an unknown amount because you don't know how much you're going to take each year. There's the RMD, which is the required minimum distribution. Those are pretty low. And typically people aren't bothered too much by the taxes on those. You might want to take out more. So it just depends, right? So with those unknowns, then you're exchanging that for certainty this year and say, okay, I'm going to take a tax hit and I'm going to do it up to this amount, however much I'm willing to. You don't have to transfer the whole thing. You can do it in chunks. And then you just trading that uncertainty in the future for certainty now so that you're realizing that tax impact. Now, the strategy with that is that when you have a low earning year, and this with business owners, business is up and down. Some years are good, some years are bad. So if you have a bad year, then it might be a good opportunity to take advantage of that bad year and apply that rollover in that year because you'll be in a lower tax rate. So you might say, so the tax rates go 10%, 12%, 22%, 24, 32, 35, 37. That's the current spread. So you might say, okay, this year I'm in a low bracket. Normally I'm in the 32% bracket. This year I'm in the 12% bracket. So I say, okay, how much are you willing to pay? I'm willing to pay 12% on as much as I can. So then we would go in and we would calculate, okay, based on your earnings projecting into the end of the year. And obviously we would wait until as late as we can to make sure our numbers are as good as possible. Based on your numbers, you have this much room in your bracket in order to still pay 12%. So you can roll over that chunk and then you'll pay 12% on that rollover. Or maybe you're good with going up to 22%. We calculate however much room there is in the 12% and then however much room there is in the 22% and say, okay, here's how much you could apply and pay at those rates. And that's really just a personal preference. If I'm willing to pay the full rate on just exchanging that future unknown for current certainty, then you can pay full rate on whatever the rollover amount is. It depends on how much is in there. It depends on what's going on otherwise in your tax life. And it depends on your opinions about those unknown factors. So that's really what it comes down to. And we can guide you through the math and give you the options. We do that with clients, not super frequently, but often enough. But yeah, that's the story with rollovers. So how do I say this? In my lying awake asleep at night, lying awake in bed when I should be asleep, things I worry about. So the biggest thing I worry about is the total balance of the qualified plans. So qualified plans includes all the retirement stuff. There's QRPs, there's 401ks, there's SEPs, there's simples, there's IRAs, all this different stuff. Take the total balance. It's about $34 trillion. Now, if you'll notice, the national debt is about $35 trillion. So the things I worry about, and this probably won't happen, but it has happened in other places. So in 2011, I think it was, everybody in Poland woke up one morning and all of their retirement investments had been replaced with government bonds. The government went in, because it's the financial system, they regulate it. It's obviously theirs to do with whatever they want. They went in and they exchanged dollar for dollar, or zloty, or whatever their currency is. And they replaced that same balance amount with government bonds. So you were invested in whatever you were invested in, and now you have the same currency amount, but invested in Polish government bonds. And so the government was saying, hey, we didn't take anything from you. We gave you dollar for dollar match. You did not have any loss, and it's even Steven. But the upside on private investment is vastly different than the upside on government bonds. I could see a similar thing kind of playing out at some point in the future when the politicians get too desperate to handle the national debt, because all of these retirement plans are creations of Congress. They could take them away if they wanted to. Now, they'd have to pay a political price for that. And will that happen? I don't know. But that's what I worry about. So if you take that tax hit now, and something like that were to happen in the future, then you took a tax hit now for nothing. And that's the thing I get concerned about. But at the 10%, 12% rates, that's small enough that it might be worth doing. If you're paying 32% or something, I would say that's probably not worth doing. But it's personal preference as far as how much you want to exchange that uncertainty for certainty. And yeah, that brings us to the end of the hour. Charlie, thanks for hanging out with us. John, thanks for hanging out. I know we got a bunch of viewers going right now, but I don't know who they are. So thanks, everybody. I will leave you with one thing. We do have a course that's going to be coming out soon. It's the 74 days course. So we talked about earlier, the 74 days that you can save yourself. This is I have an idea for a business, and this gets you to saving that 74 days on your first chunk of money. So it takes you through business setup and then basic financial setup, and then the first levels of tax strategy that applies to pretty much every business. So it gets you from zero to a good place. And then we can start to talk about more advanced stuff. And it's not out yet, but there is a wait list you can sign up for, taxsherpa.com. /74 days if you want to sign up for that. And we'll let you know when it's ready. I keep saying it's going to be like next week. The people we have producing the course, like I've recorded all the content and they're putting together all the pages and all that kind of stuff. So we're still waiting. You know how everything takes longer than you expect. At this point, I will say soon. And hopefully that'll be out soon. So we'll let you know if you want to go there and sign up for the notification list. But other than that, I got to run. So thanks everybody for coming out. And we'll see you next week. Same time, same place.
Alrighty.